Good morning. Coming to you from Park City, Utah. Uh, Dark clouds are hanging over the mountain, but it's not going to be snow. It's going to be rain, and spring is moving in quickly. Temperatures are warm, and that's some sort of a relief. But that's not what we're here to talk about. We're here to talk about what's wrong with the market and what's wrong with the world and our country, and try to figure out strategically how we should be placing our life savings. The main issue, I think, is not so much the war, not so much the politics and the rhetoric lining up to an election year. The main issue here is the inflationary symptoms that are permeating through the economy, and that is starting to worry a lot of people. All the pundits, not all the pundits, but most of the pundits on Wall Street are saying, well, we've just printed too much money, and there's just too much money out there, and that's always inflationary. Too much money chasing too few goods. But our view is a little bit different, and we'd like to explain that. When you have a fractional reserve banking system that runs the country, which is what we have, okay, every time the Federal Reserve prints an increment of money, a dollar, that money gets deposited into a bank. And the bank by law has to reserve some of it, say 10%. So out of that dollar, it reserves 10 cents. And what does the bank do with the 90? The 90 cents that's remaining gets loaned out to someone who takes that loan and deposits that 90 cents in his bank. That bank holds 9 cents and turns around and reloans 81 cents. So that dollar deposit gets multiplied. That's normal. That's normally what happens. And the multiplying factor is about 10 times, 12 times, depending upon how hot the economy is. Well, our multiplying factor's somewhere down near 1, okay? The Federal Reserve, while money has been printed over the last few years to a great amount, there's still a great amount that is sitting on the shelf that is not circulating and multiplying in our system. And that's where the analysis can go haywire. Currently, we have the banks with excess reserves. In other words, out of that dollar, instead of saving 10 cents, they might save 60 or 80 cents. And we have excess reserves in the system right now that exceed $4 trillion. Enough to cover our deficit for a year. There is a lot of cash there, but it's not circulating and it's not being counted as it normally is. And so there's a lot of misunderstanding about how much money is out in the system. If you look at our monetary base, the aggregate number, something like 50-60% of all of the aggregate number is sitting in excess reserves. Why? Well, we think the Federal Reserve has been repressive in allowing the banks to turn around and loan money, but they're also paying interest to the banks for depositing the cash with the Federal Reserve. So we have a situation that is the first time in the country where we've got these excess reserves. Now, what can Chairman Powell do? He could tell the banks, game's over. You guys are free to loan that money. And if that money hits the bankers' lending offices and these banks continue to lend on that money, it might multiply 10 times, which means we will have about $40 trillion released in our banking system. Then you've really got too much money chasing too few goods. Then you've got Banana Republic potential inflation, okay? But he hasn't done that. And he has sworn instead to increase interest rates operationally with every meeting. So he's looking ahead to 6, 7, 8 rate increases. And we counter with a suggestion that he won't have the fortitude to raise all of those rates. At some time down the road, not too far down the road, he will be looking at a economy where Confidence in the economy is just shaken. Confidence by consumers is shaken, and we're already seeing the impact of this. Some of it is a response to this inflation that we have. And when you look at the inflation and analyze it and say, well, is it coming from too much money? I'm not sure that it is, because we've got so much money on the shelf that has yet to go to work in a normal banking system way. So it's kept on the sidelines. So what's causing inflation? Well, inflation starts with the virus, the production cutbacks as people got ill and plants closed for 2 weeks, et cetera, et cetera. So we have supply chain issues, meaning that the raw materials, the finished products that we use and need are not all available because the supply has been restricted because of the COVID. Okay, so you start with that. You pile on an energy policy that was invoked by President Biden, where he shut down pipelines, shut down drilling on government lands, discouraged production of oil. And where a year ago we were self-sufficient in carbon fuels, in energy, now we have to go out and compete with it and buy it on the open market. And that is creating a problem because the price of oil, gasoline, etc., diesel oil is moving up. And it's not just the gas price. What happens is that anything oil-based, plastics, some materials, transportation, the price of diesel fuel will really impact the price of a good that has to be shipped by truck around the country. So we've got kind of a convoluted, compounding, inflationary thing that is really eating at people, eating at their income, and is beginning to precipitate a recession. You know, we think we can see the recession dead ahead. So here's the Federal Reserve Chairman raising rates when the economy is apparently heading into recession already. This is a problem. And this is the problem and the dilemma for markets, right? What kind of a world will the Federal Reserve Chairman leave us with? Is it going to be an inflationary world? And will he be able to curtail inflation? Or will he overkill this thing because of the reserves that are already sitting on the shelf and not circulating? And I'm not sure how many people see that. So from an investment standpoint, protecting your interests, you know, we're going slowly into this and very deliberately. We lean on the positive side because there are good companies, but with so much in this inflation picture, an equal amount is in the earnings picture. You know, if a company has to get raw material that happens to be oil-based, their cost of goods sold is going to go up and their profit margins are going to get squeezed. So you have earnings questions popping up. You know, how good are these earnings? How much can the earnings grow for every company and specifically some industries, right? So you have these kinds of questions all at a time when the Federal Reserve Chairman is going to do something. He's already raised rates by 25 basis points. He's talking 50, and I'm not sure he sees those excess reserves. So we just want to watch, because it could possibly mean that there's overkill, and that in trying to check inflation, he applies the wrong medicine and the patient gets sicker, right? We just don't know exactly how far he will go. You know, we've got some internal bets. I have one with our economist as to the number of times that Powell will raise rates and when he will chicken out, when he will fail to have the Constitution to keep raising rates and abandons his plan. Then what happens to the market at that point? Don't know, but we know a lot more than we did a few weeks ago. You know, the economy is bumping along, but it's slowing. This war is not helping things, but we also know that the Russian army isn't what it's supposed to be. It is malfunctioning like crazy, And Putin's got himself a mess that he's going to want to negotiate himself out of. Otherwise, he may not last. So some things are much more definite, but the big one, inflation, and what the Federal Reserve does to try to fix it. We'll be in touch. Thank you.